amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second wind.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at fideradvice.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Listen, like, follow, and share ASV. And coming this summer, ASV moves to videocast, and ASV Plus becomes available to institutions. Another bonus this summer, get the Life Cycle of Wealth book refresh online at astewardsview.com and major booksellers nationally. Chaz, you have something to say about this, I know.
I do. I was going to say, don't prompt me, because now it doesn't sound that natural, but that's okay. I would have done this even if Aaron didn't prompt me. If you are just dipping your toe in the pool of investment, wealth building, I want to encourage you to check out Aaron's book coming up. I've read the thing cover to cover. It's a short little book. Aaron, I don't know if this is appropriate to say on a financial podcast, but I would call this normally the size of a bathroom book, but I wouldn't want you to read it in the bathroom because I'm just saying it, the length of it, it's very thin, but it's got some really just core fundamentals of investing, your holdings, your assets, risk management, how to choose an advisor, just some fundamentals. And again, it was really educational for me. And again, Aaron and I have very different backgrounds, but I felt like I got an education, but it wasn't so deep that I didn't understand what I was reading. So the Life Cycle of Wealth, I recommend it.
More. The Life Cycle of Wealth. Thank you, Chaz. That's far more than I anticipated hearing from you. I really appreciate that. And as a matter of disclosure, I did not pay for that. So thank you, Chaz. Really appreciate this. But I want to say this. A big part of what we do at A Steward's View is the same thing that book was written in an effort to do, and that is to add perspective, right? To add context, to equip towards what? Towards decision-making. Okay, so we want to make sure that decision-making is excellent for whoever's listening to this program, for whoever's reading that book. These are the efforts that we're making to that end. So with that, it was another big week for long-term investors last week. Before we go there, let me say something about why we do this economic and market readout. It is to quiet the noise around us, not eliminate it. We try to keep this part of ASV brief and summative, like everything else we do, decision-oriented. If you did only listen to ASV once weekly and nothing else in the financial realm, you would hear 20 to 30 seconds of what happened last week. And then towards the end of our session, a 15 to 20 second preview of the week ahead. It's our effort and our hope to distill things for you so that you can, 1, be informed, and 2, sleep better at night. Whether you're an individual investor just getting started or an institutional investor, accredited, that is, with $1 million or more of investable assets. So with that, let's take a look at what happened in the past week. The S&P 500 index rallied every day last week, bringing its daily green streak to 9 straight days, the longest such streak since 2004. It closed the week up 2.92%. The NASDAQ 100, meanwhile, also rallied up 3.45%, and small caps rose 3.22%. International stocks increased by 3.09%, while the MSCI Emerging Markets Index jumped by 3.3%. Meanwhile, bond yields were higher, with the 10-year Treasury at 4.31% to close the week, and the 2-year Treasury closed at 3.83. We had another strong earnings week last week. Through 363 names of the S&P 500, the average earnings beat rate is now 8.6%, which is well above the long-term average of 5%. This week, the earnings season will slow down a bit with expected earnings from tech and automobiles, including Ford, Palantir, Datadog, Uber, and Rivian. The Fed has an FOMC meeting coming up this week. Markets have no expectations for a move on Wednesday, but markets will be very interested in comments regarding the June meeting. Currently, Market implied expectations are roughly 34% for a short-term rate cut in June and 100% for a short-term rate cut by at least July. These are down considerably following last week's economic data that saw a much higher than expected non-farm payroll report of 177,000 jobs added and a less weak than feared GDP report of minus 0.3%. As we discussed last week, the market looked through the national headline on GDP right to consumer consumption, which came in at 1.8% to the positive versus 1.2% expected. Now let's get going. This week on A Steward's View, in both segments, we'll talk about the ways that the Fed and Treasury can work together. In the first segment, we'll talk about the work of avoiding a major financial crisis in the U.S. and treat 2008 as a reference point. In the second segment, we'll talk about navigating the current fixed income picture and insulating our portfolios against ongoing volatility in fixed income yields in particular. We may touch on total return investing, and this will be a big topic on A Steward's View and on ASV Plus in weeks ahead. So let's look back. In 2008, the U.S. financial system effectively ran out of cash. This credit crunch toppled major banks and brokerages and prompted a number of changes from policymakers. Sweeping financial reform was passed by Congress called the Dodd-Frank Act. The FDIC raised its insurance limit and covered some money market funds also. The Treasury became an active investor and set up the Troubled Asset Relief Program, or TARP. It bought mortgage-backed securities and even distressed equity assets like General Motors and Chrysler. The Fed simultaneously used unique tactics to inject large amounts of cash into the U.S. system. This was called quantitative easing. From 2008 to 2013, the Fed bought trillions in Treasury securities, ending at $4.5 trillion in Treasury securities held by year-end 2013. The U.S. economy at that time was about $17 trillion in output, or GDP. Total GDP. That's about half of the $30 trillion that it is today. In the 15 years that have followed, the Treasury has unwound its TARP positions and has allowed its Treasury holdings to mature. It has also bought more Treasuries along the way and held $7.1 trillion in total Treasury securities through year-end 2024. So I'll leave this point and this question with our listeners. And I really want to hear from you on this program on any major platform, Apple, Spotify, SoundCloud, even social media. Here it is. If the Fed were to buy enough Treasury securities right now to lower long-term interest rates and assist the Treasury in refinancing its debt, our nation, we've said in past weeks, our nation would save $1 billion for every 0.01%, $1 billion per year in newly issued Treasury yields as new Treasuries come out, new bonds come out after the market has responded to the buying the activity we're talking about. So let's play it out. If the Fed says, well, we're going to buy another 10% of GDP onto our balance sheet, we're going to buy $3 trillion in Treasuries right now. And they have room, by the way. We've looked back 15 years to make sure of this. But if they did that, they bought $3 trillion worth of Treasuries. I don't have the analysts in-house to tell you what the yield would be, but we would be down between 0.25 and 0.50% on 10-year Treasury debt. Okay, so we just said that's every 0.01% is $1 billion in savings. So what does that mean? Well, 25 to 50 basis points, or 0.25 to 0.50 in lower market yields, the secondary market for Treasuries, as the Treasury itself comes along and refinances that debt, or it puts new bonds out to compete with those secondary market bonds, we have this savings because the coupon rate that the Treasury is printing its own debt at is 0.25 or 0.50% lower to match up with the market. Okay? So that means that annually, on a long-term basis, let's use the 10-year, for 10 years, we're going to save $25 to $50 billion per year. Okay? So I know I'm simplifying this for our listeners, but this is much of what happened for a totally different reason back in 2008. In 2008, the phrase quantitative easing came in because the same approach was taken by the Fed to go and buy up trillions of dollars of short-term and long-term Treasury securities, but it wasn't principally to lower yields in the, to affect the marketplace as to yield. It was to add cash to the system, to ease the system, to give it what it needed to sort of unfreeze the credit crunch that had gone on. So this is a different reason to do the same thing. So why not? I'm asking you now, why wouldn't we do that? I don't have a reason. I'd like our listeners to tell me what they think. Why wouldn't we do that? So I'm curious. I want to hear that input in any medium online that we've mentioned that we can discuss that together. We'll take a pause here and then I'll come right back.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, Fidere advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
So why not QE4? I mentioned how the Fed and the Treasury can work together, similar to what they have in years past. I didn't talk about the short end of what the Fed does, the short-term end of the interest rate picture. Right now, we said the 2-year Treasury closed last week at 3.83%. Interestingly, the Fed funds rate, which is the rate at which banks borrow deposits from each other or lend deposits to one another, is sitting at 4.25, between 4.25 and 4.50. Okay, so the Fed funds rate is a directly set Fed rate that is, interestingly, slightly higher than the 2-year Treasury yield right now. That simply means that we expect short-term Treasury, we expect the Fed funds rate to drop in the months ahead. Okay, so when we talked earlier in this particular episode about expectations of the Fed in the summer and fall meetings, that's exactly what the market is expecting. Okay, is that we'd have this lower Fed funds rate that the Fed sets directly, right? That is the frustration of many, that it hasn't lowered more quickly, right? President Trump is actively pursuing his social media company with this concern. He's, for whatever reason, not talking, and neither is Secretary Bessent, and I want to say that properly. I've butchered his name in multiple programs. I apologize to the Treasury Secretary for not getting his name right. But Mr. Bessent and President Trump are not discussing what we just discussed as to QE4. I'm not sure why. Right? We're getting all this attention on the Fed funds rate, which is the short-term end of the yield curve, right? The yield curve is what? It's the full picture of interest rates in this country, right? We start with cash or the Fed funds rate. The discount rate is another one that's right next to that. Okay, we can talk about the difference at some point. And then there's the Treasury marketplace, which is bills that are months long, right? We look at the 2-year as kind of a short-term expectation for, what may happen with cash rates, as we just said. And then there's the longer-term bonds, right? So when we're talking about bonds, we're typically talking about the 10-year and the 30-year bond. Okay. But the spectrum that I just mentioned, that is the interest rate picture, or as money managers like to call it, the yield curve. Okay, so when we talk about the yield curve, I remember growing up working in banks and trying to understand that language and going, what the heck, what is the yield curve? Is this like a boomerang? I wanted to, start go out and play a game with this. Okay, but it really is a pattern of where yields are at a given moment. Okay, I hope that makes a little bit more sense. But to clarify the issue, a comprehensive approach, here it is. If the Fed took a comprehensive approach and it said, okay, we're going to do something along the lines of what's expected, right? Inflation is sticky, but it's in check. Jobs reports are looking good. We're going to go ahead and lower or ease interest rates. We're going to take a more dovish position, as the language goes. In the Fed funds rate and the discount rate, so cash, that it's setting that rate, we could also see them engage in quantitative easing. Okay, so what then? Well, now we would have the yield curve, the entire thing, effectively lowered by different actions that the Fed could take. Okay, so I'll ask it again. Why wouldn't the Fed do these things? Why wouldn't we pursue those types of monetary steps? I don't have an answer for either end of the yield curve as to why that won't happen. I do believe that the market is accurately pricing in the lowering of short-term rates. That makes sense to me. I don't understand, as I've said, why we're not talking about QE4, which would be the fourth round of quantitative easing, more directed towards the 10-year Treasury and lowering that yield as America refinances, we've said it before, $6.5 trillion worth of debt between now and June. Okay, so no matter what the Fed does, what do you do? How can you respond to the current picture? There are many resources that you can go to figure out how to do fixed income investing, how you can hold fixed income, the types of fixed income that there are to invest in. This is a big, long class if we want to make it that, but I'll say it this way for the purposes of decision-making today. Fixed income has a place in many portfolios that investors hold. Okay, so if you're an investor and you're a moderate investor, you're going to hold some growth, some various equity asset classes, areas of the equity market globally, I hope. And you're going to hold some fixed income, right? Fixed income we've talked about before. You know, the definition of that, it's usually bonds, but to be exact, you're getting an interest rate back on being a borrower, right? So I have this fixed income coming back to me, kind of like, you know, I'm the bank in a way, and I'm going to receive this fixed income. You would include bank CDs in this, bonds in this, other portfolios of floating rate or bank loan securities. There are lots of ways to go get a coupon in the marketplace. And what kind of bonds, by the way? We talked about treasuries a lot. We haven't talked about corporate bonds or lower credit quality corporate bonds called high yield bonds. There are foreign government bonds we haven't talked about. There are lots of different areas of the bond market that you can invest in. My comment to our listeners is that the best approach to dealing with the bond market is this, or the fixed income areas of the market you can go to, is the same as it is for equities. In fact, putting the two together, I mentioned the moderate investor that's roughly 50-50, half equity, half fixed income, half growth, half conservative, right? We've heard about that. Underneath of those two components, diversification is the buzzword, but optimization is what my firm does. And that just means that we're going to take and we're going to build things in a way that we don't know exactly. Well, we don't know what the Fed's going to do. We don't know what stocks are going to do. We don't know what anything is, how this is going to unfold in the weeks ahead. Do we? I mean, maybe Chaz has a line to the president. He know what tariffs are, what's going to happen with the tariff picture in the next month.
DJ Trump did call me, and he said he did let me know that he's going to announce a bunch of tariffs, and then he's not going to actually do them, and he's going to announce a bunch more, and then he's going to raise them, and then he's not going to do them. So something like that. We talked it through. Okay. We got it figured out. But I can't share this stuff.
So he updated you on social that there was going to be more madness. So he called you. Okay,
he called me.
Now I can't believe you. But we digress. So the idea here is, because we don't know what's going to happen across any area of the equity or the fixed income market, we just know what conditions are. That's why we talk so much about economic conditions. We don't talk about trading in this program. So how do we allocate? How do we optimize, right? Well, if I'm a driver, I want to have a vehicle that's got 12 cylinders in it, or however many cylinders. I think we're at 15 right now. So a 15-cylinder engine, if you can imagine that. But I want those cylinders to fire at different times, right? And if half of them are fixed income and half of them are equity, I'm going to go to the areas that may have some favor, and I might tweak those cylinders a little bit and add a little bit more there in the short run. That's a tactical thing I can do. But at the end of the day, I want to have those cylinders. Why? Because the cylinders are firing at different times. Okay. So like in the portfolios that I run, we hold bank loans. We hold foreign corporate and government bonds. We hold domestic corporate and government bonds. We hold sort of an interest rate hedge strategy. Okay. We're doing things that are creating cylinders within the fixed income marketplace and entrusting that work to good managers that are long-term people that have shown themselves to be good at their one thing, that when put next to others, right, whether it's active or passive, we can talk about that more, but we really want those cylinders to fire at different times. Okay. This goes to total return investing. I'm going to stop short of talking about that in more depth, but I just want to say to fixed income investing specifically, if you're just investing in treasuries, or if you're just investing in corporate bonds, you're just doing that in individual securities, that's great. In fact, with bonds, there's a good argument for holding those securities directly and holding them to maturity. You don't have to be concerned about what happens in the marketplace. You just need to know, hey, I've got a credit quality that I can live with. What is the credit quality, kind of like the credit score of the bond or bonds that I'm holding, right, from the issuer, right, the place that I lent my money to get a fixed interest rate or a coupon amount back every so often, and then my principal back at the end at maturity, right? We've talked about bond pricing in this program. So that is a way to nothing's guaranteed, right? But that is a way to ensure or help ensure that I have a healthy amount of income coming in on my investment, an income that's knowable, and my principal back at some point. Okay. So that direct hold on fixed income is great. I encourage it for certain investors who are either extra conservative or who are sophisticated enough to understand what they've got and not attend to bond prices and yields in the short run, okay, or really at all. They're just looking for, the income and the maturity, okay? So that's another way to go. What we do in my firm is we do entrust the work to management teams that are good at their own areas of fixed income, and we build out those cylinders and we allocate to those cylinders so that we have a smooth ride down the road when we're driving that car with 15 cylinders in it, firing at different times, okay? We'll talk more about that as months go on, but I want to say that nothing is perfect. Nothing is going to completely insulate you from the changes that go on in the bond market or the stock market, and in any market. But what we can do is we can add consistency to the experience that the investor has as they drive down the road, right? We can get something not on cruise control. This isn't hold and hope. This is an active process. This is an active review process, an active updating, screening, installation of management teams. There's a lot that goes into this, but we can get more consistency in any area of the market if we're looking for it, right? So that's how we approach this. We say, okay, and I'm not going to go into our portfolios right now, but if we have, let's say we have 5 fixed income managers. They're all in fixed income. They're all more conservative than just by nature what they're holding and managing compared to the stock market, right? Whether it's U.S. government bonds or corporate bonds or foreign bonds or bank loans, whatever that is, it's more conservative than stocks. Okay, well, let's try to diversify the areas of fixed income that we're in. For example, we hold high yield bonds with 2 managers right now that are excellent at managing risk in high yield bonds. What kind of risk? Well, multiple risks. Okay, so that's a whole session by itself. So we're doing the work of building out cylinders, allocating money to managers within fixed income and within equity categories as well. So nothing's perfect. The effort isn't complete insulation. That's not possible, but what we can do is add consistency. So I hope that makes sense. Right now, there's been so much going on in just since this program started on March 3rd. I would just say this. The market has moved off of a bottom, right? I've been saying wait for that move to happen. for about since Tariff Day, since what was it called? Liberation Day, Chaz. I think that was the language, April 2nd, okay, where we had this big drop and we had a bottom on April 8th in stocks. But since then, I mean, we've seen stocks come back up above where they were before April 2nd. So we've seen the move off of a bottom. You know, I had a number of conversations with investors right around that bottom, before it and after it, and it was the exact same conversation we've been having in this program. So now that we're off that bottom, hopefully we've reinvested cash coming off that bottom. If we had it, we've rebalanced. If we were going to rebalance, we've done it. We're not still sitting in cash. We're not waiting. But let's then continue to be patient through what? Through probably more volatility. Okay, so if Chaz and the president are talking, you know, and Chaz is going to, you know, mention the chaos, and that's a joke. They are not talking, and we do not have insider information on tariffs. But the whole point is to maintain your investment plan no matter what happens. Okay, so the bottom has come and gone, at least the one we had here in the month of April. Let's talk more about what you can do now that we're off of it, as more volatility lurks around the corner. So as to current conditions and how to navigate, please schedule with Fideer if you want to, in the footer of our webpage at fideeradvice.com. That's the sponsor of this program. That's the firm that I manage. Also in the footer of our webpage, you can pick up a historical summary of the Fed's Treasury holdings from 2007 to 2024. That's in the ASV White Paper series, I'll guarantee by Tuesday, the 6th of May at 10 p.m. That's currently without a fee. Chris Gerber worked very hard on putting together that historical summary, and I think it'll speak to the QE4 that I was asking about. And good news in the housekeeping department, our Minnetonka, Minnesota studio is built and ready for YouTube in June. Quieter week. We'll get ISM and PMI service data on Monday. We can talk more about what those are, the Purchasing Managers Indicator and the Institute of Supply Management manufacturing data. Those are both coming out today. Tuesday, we'll get the trade balance report. On Wednesday, we have the FOMC meeting as well as consumer credit. And finally, on Thursday, we'll have weekly initial jobless claims. So with that, unless your goals have changed, let's just continue on the path through 2025 and really the first half as we go. Although markets have been volatile, let's talk about a little bit of the year-to-date number. I haven't mentioned this. The S&P 500 has only declined 5.85% through last Friday, year-to-date. That's not much. And it's up 8.34% in the past 12 months. So that index has been in correction territory, but it's up about 8% the past 365 days rolling. So we'll end with that good news. With that, it's been a pleasure to be back with you. I hope you found this session to be a benefit to you and others you decide to share it with. We invite you to interact with us on Apple, Spotify, and SoundCloud, even social media. You can visit our hosted podcast page and schedule with our sponsor, Fideer Advisors, at astewardsview.com. And from all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fideer Advisors or speak with Aaron, visit fideeradvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit Fideer Advice and click on A Steward's View podcast link at the top of the page. A Steward's View is brought to you by Fideer Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fideer maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fideer and its representatives do not offer tax or legal advice through Fideer. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.